Hi everyone, welcome to the channel. Recently I was asked to review some Indian stocks. So today we're going to look at the company HDFC Bank, ticker HDB, the Indian-based banking business and sixth largest bank in the world based on market capitalization. So we're going to take 2 to 3 minutes to look at their financials, then go into their stock valuation. First, regarding their financials, their 2024 fiscal year ends this March, but their financial report will not be available for a few more months. So, all this data we're going to look at is based on their 2023 results. A quick look at their numbers. For the most part, everything appears to be growing. And since India is a emerging market, this should be expected, particularly for their banking industry. And for the first three data points, we're going to look at revenue, net income, earnings per share, all of which had continued growth throughout the past 10 years with no declines, with revenue up 240%, net income more than 360%, and earnings per share nearly 300%. So good signs here for a growing company. Then dividends, when companies do pay them, I like seeing the dividend increasing over time, which HDFC was achieving up until fiscal year 2021 when they did not issue one. But they did restart that payment back in 2022. And for 2023, it was the highest over the past 10 years. So hopefully they can continue this dividend increase as they move forward. And then for shares, now normally I like seeing these decreasing over time, but clearly HDFC has been diluting shareholders for the past 10 years. But as we mentioned, the company has seen continued growth with revenue and income and earnings per share during the same time period. So not as much of a concern, but still something that I would hope would level off and eventually start decreasing at some point in time in the near future. And then finally, free cash flow, a few down years to include fiscal year 2023. But over the past 10 years, it has increased more than 170%. And it's clear that from these results here, the company is making cash. So good sign. And this is what we want to see when we do our stock valuation. So let's jump down and perform that valuation. So here's the valuation for HDFC Bank, and we will look at making some modifications in a few minutes, but my intrinsic value, just over $56, and with a 80% margin of safety, brings it to just below $45. Now, this is based on a 10% short-term growth rate over the next 10 years with a 10% discount rate. I am using a 3% long-term growth rate. Now, up in the top right here, we can see net income CAGR over the last 10 years, 18.5%, while earnings per share CAGR'd at 16.6%. So my short-term growth rate of 10% is conservative, considering those other growth rates we've seen for the company over the last 10 years. And the reason why I'm showing a lower short-term growth rate is just to be a little more conservative. This is an emerging market. I don't fully understand it as much. But if you're someone who has a little more knowledge or a little more optimistic of India and their potential growth, I could see increasing this short-term growth rate to 12, maybe even 14% if you're really that aggressive and confident in the continued growth of their economy. So let's just take a look at what those valuations would be if we do use a 12 and a 14% short-term growth rate. So 12% short-term growth rate, intrinsic value jumps to just below $66, and with an 80% margin of safety, brings it to just under $53. Now, you don't have to use the 80% margin of safety. Again, I'm using that, probably be a little more conservative. You could probably increase that to about 90%, but I'm using 80% just to be a little more conservative. Now, let's change that short-term growth rate just to see 14%. And with a 14% short-term growth rate, jumps up to just over $77. And with that same 80% margin of safety, brings it to just under $62. Now, the stock is trading about $55, $56. So if we're using that 10% that we saw originally, it doesn't really give much of a margin of safety and pretty much trading at its fair value. But if you want to look at one of these higher growth rates, 12, 14%, yeah, you could see some opportunity if you do have a more positive and bullish outlook for the company than I do. Again, it is a growing market, so there could be a great chance to make some a good return over the coming years. But let's look at some other data points. PE ratio of 17. It's probably a little higher, at least for a U.S. bank, but this is a growing company, so maybe 17 is more appropriate. However, long-term debt to free cash flow, we can see just under 5. Now, I normally like seeing companies under 3, so this is higher than what I normally like to see. So if you are going to invest, definitely take that into account with your margin of safety. Then dividends, as we did discuss, they were growing. They did have, I think it was 2021 when they did not pay it, but still, based on their recent payment back in fiscal year 2023, it is up almost 300% from those dividends back in 2014. And then share count, as we mentioned, they have diluted share count, but it's only 16%, so not too bad for this growing company. But still, I like to see this eventually level off and start to decline. And then net profit margin. Now, I normally like seeing 10% or higher. We see the last 10 years, 33%, and the last 3 years, almost 38%. So great sign there, great data point. So I like these margins, especially for a bank. So again, probably has to do because this is a emerging market. And then another data point I like looking at is return on invested capital. So normally I like seeing this over 10%. We can see they're just below that 10%. And for a bank, this is pretty high. So that is a good sign. And again, if you're positive on India and its continued growth, this could be an opportunity. But for me, I'll pass on this, though they have some great metrics. So if somebody is a lot more familiar with this market and their potential growth, probably a good opportunity for you. So I hope you enjoyed this video, got some useful information. If so, consider subscribing, and I'll see you next time. Thanks for watching.